$1,000 in 5 stocks will replace your job. What if the path to financial freedom didn't begin with a lottery ticket, a viral business idea, or a 6-figure salary, but with just $1,000 and a smart investment strategy? What if 5 carefully selected stocks, held with patience and intention, could grow into something powerful enough to one day cover your living expenses? And perhaps the most important question of all, are you willing to think long-term in a world obsessed with quick results? The idea that $1,000 invested in 5 stocks could replace your job may sound exaggerated at first. After all, most people spend more than that in a month on rent, bills, and groceries. But the real power of that $1,000 isn't in its size. It's in what it represents: ownership, discipline, time, and compounding growth. The journey from employee to financially independent investor does not happen overnight. And it certainly doesn't begin with millions. It begins with a decision. When you invest in a stock, you're not just buying a symbol on a screen. You're buying a piece of a real business. That business sells products or services, hires employees, generates revenue, and ideally produces profits. As the company grows, your small ownership stake has the potential to grow with it. Multiply that concept across 5 strong companies, and you begin to build something more resilient than a single bet. Why 5 stocks? Because diversification matters. Putting all $1,000 into one company exposes you to unnecessary risk. If that company struggles, your entire investment suffers. But when you divide your capital across multiple strong businesses, you reduce the impact of any single disappointment. The goal is not to gamble. The goal is to build a foundation. Imagine allocating that $1,000 across 5 different types of companies. One might be a well-established global brand with decades of profitability behind it. These are the kinds of companies that have survived recessions, inflation, and shifting consumer trends. They may not deliver explosive growth, but they provide stability. Stability is underrated in a world that constantly chases the next big thing. Would you rather own a business that quietly compounds for decades, or one that spikes dramatically and crashes just as fast? Another portion of your investment could go into a high-quality growth company. Growth businesses often reinvest profits into expansion, innovation, and new markets. Their stock prices can be volatile, rising quickly when earnings beat expectations and falling sharply when results disappoint. But over time, strong growth companies can multiply in value. Think about how technology has reshaped the world over the past 20 years. What industries today are still in their early stages? Artificial intelligence, renewable energy, digital payments, healthcare innovation. These are areas where tomorrow's giants are still being built. Could one of those companies become a core driver of your portfolio's growth? A third stock might focus on income. Dividend-paying companies distribute a portion of their profits to shareholders regularly. At first, the payments may seem small. A few dollars here and there may not feel exciting. But when those dividends are reinvested, they begin to buy more shares. Those additional shares produce more dividends. Over years and decades, that cycle becomes powerful. This is the engine behind long-term wealth creation. Have you ever considered how different life would feel if your investment sent you money every quarter, whether you worked that day or not? Another piece of the portfolio might target innovation and transformation. These companies may operate in emerging sectors, developing technologies or solutions that could define the future. They carry higher risk, but they also offer the potential for extraordinary growth. Including one innovative company introduces upside without putting your entire portfolio at risk. It's a calculated exposure to possibility. If one breakthrough reshapes an industry, you participate in that growth. Finally, a defensive company rounds out the strategy. Defensive stocks operate in industries that people rely on regardless of economic conditions. Utilities, consumer staples, healthcare providers, these businesses often remain steady even during recessions. When markets become turbulent and headlines grow alarming, defensive stocks can act as stabilizers. Wouldn't you prefer a portfolio designed not just for bull markets, but for storms as well? Of course, the real transformation doesn't happen because you bought 5 stocks. It happens because of time. Time is the invisible multiplier that turns modest beginnings into meaningful wealth. If your portfolio grows at an average rate of 8 to 10% annually, the growth may seem slow at first. But as years pass, compounding accelerates. Returns begin generating their own returns. What started as $1,000 can grow far beyond its original size, especially if you continue adding even small monthly contributions. This is where most people underestimate the process. They look at $1,000 and think it's too small to matter. But what if you invested that $1,000 and added $100 each month? What if you reinvested every dividend? What if you stayed consistent for 20 years instead of 2? The difference between short-term thinking and long-term discipline is enormous. Are you measuring success in months, or are you measuring it in decades? Replacing your job with investment income doesn't mean quitting next year. It means gradually building assets that generate cash flow. In the early years, your portfolio's purpose is growth. Later, as the balance increases, it can shift toward producing income. Dividends, capital gains, and compounding returns begin working together. At some point, your investments may cover a bill. Later, they may cover several bills. Eventually, they might cover your core living expenses. Financial independence is not necessarily about luxury. It's about freedom. Freedom to change careers without panic. Freedom to start a business without desperation. Freedom to negotiate better terms at work because you are not entirely dependent on your paycheck. If your investments paid for your rent or mortgage, how differently would you approach your job? If your portfolio covered groceries and utilities, would you feel more confident pursuing your passions? The journey requires patience. Markets fluctuate. There will be years when your portfolio declines. Economic downturns are inevitable. The investors who succeed are not those who avoid volatility entirely, but those who endure it. Selling in fear locks in losses. Staying invested allows recovery and growth. Can you remain steady when headlines scream uncertainty? It's also essential to approach investing with knowledge rather than hype. Buying stocks because they are trending on social media rarely leads to lasting success. Understanding how a company makes money, how it manages debt, and whether it has a competitive advantage matters. Thanks for watching. Don't forget to like and subscribe to our YouTube channel.